Foreign investors are finally coming back to India, and the market is loving it. But before you get too comfortable, let's talk about what's really going on. Simmering trade tensions between the US and China, plus our own stubborn inflation, are creating a massive tug of war. And right now, the Sensex is caught in the middle, sitting on a dangerous tipping point. One of these forces is about to give, triggering a major move. In this video, we'll break down the key events happening this week that could decide which way the market breaks and what that means for your money. Friends, what we're seeing in the market isn't just your normal everyday ups and downs. This is something bigger. Picture a giant weighing scale for a moment. On one side, you have the heavy positive weight of returning foreign money, a huge vote of confidence in the India growth story. On the other, you have two equally heavy negative weights, the threat of a global trade dispute and persistent inflation here at home. For weeks, these forces have been stuck in a deadlock, causing the Sensex and Nifty to swing wildly with no clear direction. But this balance is fragile, and it can't last forever. This week, a series of events are lined up that will likely force one side to win. The result will be a decisive, powerful move in the market. The big question is, which way will it go? Today, we're going to look at the hard data, understand the thinking behind the big money moves, and lay out a clear roadmap. We will identify the exact triggers you need to watch and explain what they mean for you, whether you're a short-term trader or a long-term investor. This is the crucial information you need to handle the volatility that's almost certainly coming. First, let's set the scene. Feeling a bit of whiplash lately? You're not alone. The Indian stock market is a picture of confusion right now. One morning, the headlines are shouting Sensex soars on FII buying, and you feel like the bull run is back. The very next day, it's Sensex plummets on global trade fears. All the gains are gone, and fear creeps back in. This back and forth, this extreme swing between greed and fear is a classic sign of a market at a crossroads. And it isn't random noise, it's a symptom of a deep conflict. The India VIX, our market's fear gauge, has been slowly ticking up. While it's not at panic levels yet, this gradual rise tells us that traders are bracing for a big move and buying protection against a potential drop. The market is pricing in turbulence. So, what's the deal? The disconnect is this. India's domestic story remains incredibly strong, but we don't live in a bubble. We are tied to a global economy that's showing signs of sickness. The market is caught in a tug of war. On one side are the bulls, led by foreign institutional investors, FIIs, who are betting on India's long-term potential. On the other side are the bears, who are looking at the dark clouds over the global economy and saying, when the world catches a cold, India can't avoid a sneeze. This tug of war has pulled the rope so tight that something has to give. The Sensex is trading in a range, testing key support levels only to bounce back and test resistance. But ranges don't last forever. They are just the quiet before the next big trend. And the events of the next few days are going to decide if that trend is up towards new highs or down into a correction. All right, let's talk about the good news first. The leader of the bull army is the FII, or the smart money. After months of seeing them consistently sell, the tide is finally turning. And let's look at the trend, because numbers don't lie. After pulling out significant funds in September, FIIs have turned into net buyers in the first part of October. We're seeing provisional data showing net buying for several consecutive days. This reversal is significant. It's like a massive tanker that has been moving in one direction, finally starting to make a turn. So why are they coming back now? What's changed? It boils down to three main reasons. First and most important is the India growth story. In a world where major economies are staring at a slowdown, India stands out. Our GDP is forecast to grow at a healthy clip, while other nations are struggling. Foreign capital naturally flows where it can find growth. And right now, India looks like the most fertile ground. This isn't just on paper. On the ground, we're seeing a huge push in infrastructure and a revival in manufacturing, which gives foreign investors the confidence to put their money here for the long haul. Second, the recent market correction has made our stocks look attractive again. A common complaint last year was that Indian stocks were too expensive. The recent dip gave a much-needed reality check, creating a better entry point for large investors. FIIs are value conscious. They don't like to chase markets at their peak. This consolidation gave them the opportunity they were waiting for. Third, look at where the money is going. It's not random. A big chunk is flowing into banking and financial services. Why? Because banks are a direct bet on the economy's health. With strong credit growth and healthier balance sheets, FIIs see Indian banks as a prime way to ride the economic recovery. Another major recipient is the IT sector. This might be surprising given the slowdown fears in the US, but the logic is that the sell-off in IT stocks was likely overdone. The long-term digital transformation story hasn't gone away, and at these corrected prices, FIIs are betting on an eventual recovery. When FIIs buy, it creates a positive ripple effect. It injects liquidity, boost sentiment for retail investors, and help stabilize the rupee. This flow of foreign capital is the fuel the bulls have in their arsenal. But before we celebrate, it's time for a reality check. While the FII bulls are trying to charge ahead, a powerful army of bears is standing in their way. The biggest threat is the renewed trade friction between the US and China. The dragon and the eagle are clashing again. Recent developments saw China announce new export controls on critical rare earth minerals. In response, the US threatened a new, steep 100% tariff on Chinese goods, which could go into effect as soon as November 1st. Why should a fight happening thousands of miles away worry an investor in Mumbai? Simple. In today's world, when these two giants fight, everyone feels the tremors. A full-blown trade war slows down global growth and creates uncertainty, which markets hate more than anything. For India, the impact is direct. Our biggest export markets are the US and Europe. A slowdown there means less business for our flagship IT and pharma companies. It hits their earnings, and when earnings fall, stock prices usually follow. It also hurts demand for commodities, which is bad news for our metals and energy sectors. The second bear weapon is closer to home, our own stubborn inflation and a Reserve Bank of India that isn't playing around. The inflation monster isn't dead. The latest retail inflation data for September saw a slight uptick, though it remains within the RBI's tolerance band. This is driven by volatile food prices and global energy costs. This puts the RBI in a tough spot. It has to balance growth with its main job of controlling inflation. In its recent policy meeting, the RBI governor, while keeping rates on hold, made it clear they won't hesitate to act if inflation misbehaves. The message was, our eyes are firmly on inflation. Why is this a threat? High interest rates are like gravity for stock prices. First, it makes borrowing more expensive for companies, which hurts profits. Second, it makes safer options like fixed deposits more attractive, pulling money out of the volatile stock market. And third, higher interest rates simply make future profits less valuable today, causing analysts to lower their price targets for stocks. This hawkish stance from the RBI is a major headwind that counters the optimism from FII buying. So, the market is balanced on a knife's edge. What could break the stalemate? Here are the critical events happening this week that you need to watch like a hawk. First, and most immediate, is the release of the US Consumer Price Index, or CPI data. Recent reports indicate the release for September's data has been rescheduled to Friday, October 24th. This is arguably the most watched economic number in the world right now, as it guides the US Federal Reserve's actions. What should you look for? The market has an expected number. What matters is whether the actual number is hotter or cooler than expected. If US inflation comes in hotter, it's bearish for markets everywhere, including India. It kills hope of an early interest rate cut and signals the fight against inflation isn't over. But if the US CPI number comes in cooler than expected, you can bet the bulls will see it as a green light. It could give the US Fed the justification it needs to ease off, potentially weakening the dollar and unleashing a wave of FII money into markets like ours. The second trigger is any headline coming out of the US-China relationship. While no major talks are officially scheduled, the situation is incredibly fluid after last week's tariff threats. The market will react instantly to the tone of any new developments. If you see words like constructive dialogue or de-escalation, expect a relief rally, especially in beaten-down sectors like IT and metals. On the other hand, if the rhetoric gets more hostile with new, concrete restrictions, expect sharp selling pressure as the market prices in a global slowdown. The third trigger is domestic. The start of our own Q2 earnings season. The early announcements from the giants, especially IT leaders and major private banks, will set the tone for the entire market. What's even more important than the numbers themselves is the management commentary. Are they optimistic about future business, or are they warning of a slowdown? Their words are a real-time check on the health of the global economy. If IT management sounds confident, it could spark a rally. But if their commentary is weak, it will confirm the bears' worst fears and could trigger a market-wide correction. So, what should you do tomorrow? That depends entirely on your risk appetite and how long you plan to stay invested. For the short-term trader, the message is simple. Be careful. The next few days will be volatile. This is not the time to be a hero trying to catch a falling knife. A strict stop loss isn't just a good idea, it's your best friend. Keep an eye on the key technical levels for the Sensex. Some analysts are watching 81,500 as a support level. On the upside, a key resistance area to watch is around 83,000. A smart trader might wait for a decisive break of these kinds of levels before making a big move. Capital protection is key. Now, for the long-term investor. For you, this is all just noise. This volatility is an opportunity, not a threat. Your focus isn't on the next week, it's on the next decade. The India growth story is still intact, regardless of a trade spat or a small rate hike. A market dip driven by global panic is a chance to buy high quality, fundamentally strong companies at a discount. Your strategy should be to ignore the daily drama and stick to your plan. Keep your systematic investment plans, SIPs, going. If the market takes a significant hit, consider deploying spare cash to buy more of your favorite stocks. Focus on sector leaders with low debt that are tied to India's domestic consumption and infrastructure themes. This volatility is the price you pay for the long-term returns that equities can offer. Don't let short-term fear shake you from your long-term goals. So there you have it. The market is at a critical fork in the road, caught between bullish FII inflows and bearish global headwinds. The winner will likely be decided this week with US inflation data, US China trade headlines, and our initial earnings reports acting as the main triggers. If you got some value out of this breakdown, do me a favor and hit that like button. It really helps us know we're on the right track. And for more analysis to help you navigate the market with confidence, make sure you subscribe and press the bell icon so you're the first to know when our next video drops. And as always, please remember this video is for educational purposes only. The stock market has risks, and you should always consult a qualified financial advisor before making any investment decisions. Thanks for watching.